We're now going to look at a bit of revision of F9. We're going to go through and look at the portfolio theory and how that then leads us into the capital asset pricing model. We're then going to go through and just take it a little bit further and think about how we can then use the capital asset pricing model to help us make decisions about whether or not we're going to buy shares within a company or whether we should sell shares within our company. So something just a little bit new, a little bit different to add into the P4 syllabus that we haven't seen within the F9 syllabus. The first bit that we're going to kick off with, as I said, is looking at your portfolio theory. Now remember what we were looking at there in the old days of F9. The key thing was that your shareholders didn't want to put all of their eggs in one basket, so to speak. They didn't want to go through and just own one or two shares because that would give them too much risk. As one share is performing well, the other share may be not performing as well, and hopefully that risk would be offset against each other. But we need to hold more than just two shares. We need to try and diversify our risk. And what we're going to go through and do is we're going to go through and hold a portfolio of shares. Now, when we're going through and looking at the risk that we are trying to diversify away, it's very important that we consider the type of risk that an investor is subject to when they make their investment decisions. Because if we go through and look at a company's risk, that can be split out there into your systematic and unsystematic risk. Now, when we're going through and looking at our systematic risk, that's the type of risk that affects all of our companies on the stock exchange, but to a different extent. So if we think there about changes within the rates of inflation, if we think about political events that may have happened, that will go through and impact the price of a company's share. It may go up, it may go down, but it will go up or down depending upon the industry that that company operates within. Now, it's very important there that we look at the different types of industry and see how that change in the political environment, the change in the rate of inflation can impact that company. So if we go through and think about increases in the rate of inflation, that could have an impact on, say, a holiday company. Because as prices go up, people are less likely to be able to afford to go on holiday, so therefore your holiday company value shares may go through and decrease quite significantly. But if you go through and think about a supermarket, if inflation goes up, yes, the value of the supermarket may decrease, but maybe not as significantly because people need to go through and eat. They're going to go through and carry on buying the food, even though it's at inflated prices. Now, the key aspect there about your systematic risk is that it cannot be diversified away. You can't eliminate any of that risk when you hold your portfolio of shares. However, what we can go through and diversify against is that specific risk. So the specific risk within our investment may be that it is impacted by the weather. So the common example that I'm sure you've all gone through and seen before is thinking about your umbrellas and your ice creams. Quite simply there, you can diversify away the risk to do with the weather, specifically against those investments, because when it's hot, people will go through and buy your ice creams and you'll get nice high returns. But when it's hot, it's not raining, so therefore you will get low levels of returns, but they will offset against each other and give you a constant periodic return over time. Now, what you've got there, the key that we're going to look at, is that if we assume that we have a well-diversified shareholder, now there we're assuming that we have between 15 and 20 investments, then if you're looking at being a director of a company that's trying to manage the levels of risk that a well-diversified shareholder is exposed to, then you're looking at the risk that they are exposed to being that systematic risk. Now, your role as a company director is to go through and give the investors a return for the level of risk that they are exposed to. So how are we going to go through and measure the systematic risk that an investor is exposed to? That's just going through and looking at the capital asset pricing model. So there, as you've all seen before, CAPM for short. Now, there's nothing different, there's nothing new that we're going to go through and add in terms of CAPM. So let's just go back and just recap what the CAPM formula was. Now, your CAPM formula goes through and looks at three variables. We have to take account of the risk-free rate of return, we have to look at the return on the market, and also your beta factor. So remember that you've got KE is equal to RF plus beta multiplied by RM minus RF. Now remember that the RF, that there is your risk-free rate of return. So if you like, the return that you'll get from investing in your risk-free investments, such as your government bonds or your government gilts. If we look at RM, that there is looking at the average return on the market. Now there, when we're looking at a return, we're looking at a return with respect to dividend growth and also the growth within your share price. Now, we don't have to calculate it. It will be given to you there within the exam, and it's likely to have been calculated by the examiner based upon a growth rate in dividends, an increase in share price, and somewhere between the last 5 and 10 years. Don't worry yourself too much about that. As I said, it's given to you within the exam. What you've then got there is your beta factor. Now, all that goes through and does there is that measures the level of systematic risk that your share has. Now, what you can have there is that you can have a beta factor less than 1, a beta factor equal to 1, or a beta factor greater than 1. Now, if you've got there a beta factor equal to 1, then what we're saying there, that the return on your share is going to be the same as the return on the market on average. So you are not exposed to any more risk than what the average risk is on the market portfolio. If you have a beta factor greater than 1, then what we're saying there is that you have a share that has more risk than the market portfolio. What we can refer to that as is sometimes as an aggressive investment. So whereby it will respond significantly to any changes in those macroeconomic factors, such as political, economic factors, such as changes in the rates of inflation. Now, examples there, you could go through and think along the lines of British Airways, Rolls-Royce. If there's any change in the rate of inflation, any changes there within political circumstances, those share prices tend to react quite dramatically to any changes in those situations. If you've got then a beta less than 1, you hold an investment that is less risky than the rest of the market. Now that there is referred to as a defensive investment. Examples there are all of your supermarkets. So in the UK we have Tesco's, Sainsbury's. In America you've got the likes of Walmart. On the continent you've got their Carrefour. Again, it doesn't really matter what happens politically, economically, they're going to perform pretty well and their value won't change so much with changes in your political or economic environment. Now, I'm not going to go through and do a numbers example there on CAPM because I just think it's too basic for the world of P4. We will see some numbers a little bit later on, but we're going to leave it for the time being there. There's examples that you've got in your material. It's nothing exciting and it's nothing all that different from what you've seen before. However, even though you're going to get numbers examples within the exam, you will also get those discursive aspects of any question. Now, what you have to go through and do here is ensure that you're happy with those discursive aspects. Here, I just think it's a case of taking some time out, learning the assumptions that we have in terms of your capital asset pricing model, and then applying them there within the exam. Now, what you've got here are 5 assumptions to do with your capital asset pricing model. So, first one that we have there is that all shareholders hold the market portfolio. Again, that may not be the case. It's saying there that your shareholders are well diversified. They may not be. You know, you could be an investor, I could be an investor, and just hold 1, 2, maybe 3 share portfolios. It's unlikely that everybody is going to go through and have 15 to 20 portfolios. Second assumption there is that we have our perfect capital markets. So there, we're talking about the world of no transaction costs. Because if there are transaction costs, that's going to go through and dilute shareholder wealth. Likewise, we have perfect information. So perfect information allows us to go through and quantify the level of risk and apply that to the level of return that we then expect for the given level of risk. Again, perfect information isn't 100% true. There are transaction costs, but again, we just assume that there are no transaction costs. There is perfect information to make our life that little bit more simplified. Third assumption that we've got is that your investors can borrow and lend at the same rate. So they're borrowing and lending at your risk-free rate. So that then forms the first step, the first part of your capital asset pricing model formula. The fact that you take your risk-free rate of return and then add on a beta factor applied to that risk premium that we have for investing on the markets. Again, it's not the case in reality that we can borrow and lend at the same rates. Yeah, if I lend my cash to the bank and put money on deposit, I get a very meagre rate of interest. However, if I borrow some cash from the bank, they go through and charge me high rates of interest. Let's not go through and talk too much about banking. That would just be too controversial. But we just go through there and look and assume that borrowing and lending for investors is at the same rates. Fourth point there is that we're looking for a single time period only. So we're looking there at a period of a year. Okay, we don't go through and address the model for 2 years, 3 years, 4 years and beyond. We just look at the level of risk, quantify the level of risk and apply it to the level of return for that 1 year. So that beta factor just looks at the level of systematic risk that is there currently within the company. Doesn't take any predictions about the future. What you've got there as well is that your investors have the same expectations. Reasonably true in the fact that we all want to make money. We all want to go through and invest in shares and get ultimately richer. It's the whole purpose of investing within the stock market. But different expectations there are looking at the returns that you get. You know, people will invest within some shares to get themselves a dividend that grows every single year. However, some people might be prepared to sacrifice that dividend growth every year, maybe get no dividend at all, in the hope that they will go through and get significant levels of capital growth. So people have the same expectations to generate cash, but some want dividend growth, some want capital growth. We just go through and look at it and say, let's put it in the same pot and assume that we have all the same expectations. Now again, if you go through there and look at those 5 points, I think you can go through there and learn those 5 points in terms of the assumptions and get yourself 3 or 4 pretty straightforward marks within the exam. So my recommendation is to get your notes, revise them, stick it there within your memory to make sure that you can regurgitate it within the exam. Easy marks if ever there has been.